Another popular way of identifying longer-term trends is to use an independent market internal indicator such as the VIX. The VIX.X, when set to a longer term interval like a 45 or 15-minute bar chart, will work well to identify these changes in market directions and pretty well give you the pattern of the day. Now, we've once again used our Z-score indicator. We find that that's a real good tool for this purpose. Now, it's not going to give you real good entries, but you just want to visually consider what's happening on the Z-score in relationship to the VIX, and you can pretty well determine what direction the market's going to head. So we use the Z-score in the same fashion that we would use it in any other than the fact that, of course, the VIX moves in an inverse relationship to the SPOOs. So here, for example, it's very obvious that we're below the zero line, so we don't want to be trading in the wrong direction. Now keep in mind, below the zero line is bullish. Alright? Below the zero line is bullish. Above the zero line is bearish. Okay? So in this case, when we're in the green, we're long. Yellow, we're short. And we're trading in the direction of the slope of the Z-score. So if the slope of the Z-score is moving up, then we obviously don't want to be taking a long trade. If it's moving down, below the zero line, that's long. Moving up above the zero line is short. So using a 15-minute chart will give you the same idea, but having a little bit more resolution. It's very easy to follow. Now, if you want to know a little bit more about how to read the VIX, go to the divergence section of our website, and we have some excellent rules to follow when following the VIX. And those rules really do work. They're excellent rules to follow, helping you to more specifically recognize where changes in the direction of the VIX is most likely. Now, when you're plotting the VIX in a slightly faster chart, like a 15-minute or even a 5-minute chart, you can see some of the instances of divergence, and that'll be very useful in determining when there's liable to be a change in market direction. Now, we'll just use the momentum portion of the Z-score to show you this. Here, as we had a gap up on the VIX, and the momentum portion of the Z-score here is already dropping as the VIX goes up, it's real clear. You're going to get a change in direction here. So get ready to go long. And here, as it just happens to drop below the zero line, right at the high, perfect opportunity to start getting long. Here again, we move up on the VIX, then we see the momentum portion of the Z-score beginning to drop, indicating we're moving very close to the time when we're going to change direction. And the Z-score then makes it real clear. Similarly, as the histogram here starts to lose strength, starts moving in the opposite direction, and here we find the lows of the VIX are now beginning to move sideways. More than likely going to be a change in direction here. All right, now we're We're just getting a little lower on the VIX here. 1649 here, 1649 there. But look at the histogram, right? Major divergence on the histogram, and the z-score then very quickly begins to move in the opposite direction. So it's easy to see, real easy to see. Easier it is to see, easier it is to read. More likely you're going to be able to identify good trading opportunities just by visually comparing where the VIX is to the z-score, the histogram, as well as the zero line. Excellent methodology for determining more significant changes in market direction. And that completes this brief discussion of z-score and the VIX.